Hello, and welcome to LaRouchePAC's four-part series on LaRouche's four laws. Last week we had guest Paul Gallagher from Executive Intelligence Review to discuss Glass-Steagall. We have him returning this week to discuss national credit and banking. We'll get to him in a moment. I will just add that if anyone who's watching this discussion has a question to ask Mr. Gallagher, they can send an email to larouches4laws@gmail.com, and we'll try and intersperse any relevant discussions throughout the presentation. So with that, I'll hand it over to Paul Gallagher.
Okay, thank you. Let me just, since this is a video presentation, let me just apologize very briefly at the beginning. The condition of my face is temporary. It's a treatment, so it's benefiting me, even though it may be challenging you to look at me. But there are a lot more challenging things that we're dealing with overall in the world. So to our subject, which is national credit and banking, the second of the four actions that Lyndon LaRouche back in March very firmly laid out that Congress had to take during this session, beginning with the impeachment of Obama, beginning with the restoration of the Glass-Steagall Act. This is the second of those indispensable legislative actions that they have to take. And we've had to, over the past 3 or 4 days in Congress, an unusual step. People may have heard about it by now, that the Congress on Friday, by an overwhelming bipartisan majority, reasserted its jurisdiction over making war and peace and over deploying U.S. armed forces into harm's way in a resolution which barred Obama from sending combat troops to Iraq without explicit congressional authorization. A major step, one which was interpreted by most of the leaders involved in it in Congress as not just an action on Iraq, but an action on the retaking of a prerogative of Congress long lost to the executive, and a very important step in avoiding the threat of world war. More to our point now, over the past 2 weeks, we've had 5 countries join together to form 5 countries with high rates of economic growth, which tells you right away the United States was not one of them, joined together to create both an investment bank called the New Development Bank for investment in infrastructure among themselves and in third-party borrowing nations, and in order to create a currency stabilization fund of equal size, $100 billion, in order to protect their currencies from speculative attacks and sudden drastic devaluations which can throw their economy for a loop. Because the crucial importance of this is the very rapid growth relative to the United States and Europe, the transatlantic world, which China, India, Russia, South Africa, and Brazil have had over the recent period. For example, in the last 6 years combined, as I mentioned last week, the OECD countries, so-called, United States, Europe, Japan, Canada, have grown by 11% over 6 years combined, total of 11%. These 5 countries have been growing at a rate of 5 to 8% in their economies every year during that same period of time. China has been investing in infrastructure 8% of its GDP for more than 20 years, with the result of this extremely high rate of growth. The United States, by contrast, has been investing recently 1.4 to 1.5% of its GDP in infrastructure. So there is a choice between the condition in which our economy has fallen, one in which there has been mass unemployment. It has then been succeeded by mass part-time employment and by mass low-wage employment, in which there has been virtually no investment in infrastructure and therefore in increasing the productivity of the labor force. And so, are you having trouble hearing me? Because I'm not hearing you.
We can hear you just fine, Paul.
Okay, now I can hear you again. I'm sorry. I thought because it had gone silent that we had a problem.
No, I just went on mute. Go ahead.
Okay, good. So we have the alternative, we, the United States, have the alternative, the option in front of us to cooperate with this initiative, join this bank, issue credit into this bank. We will be among the greatest beneficiaries because of the exports, because of the investments of international development banks in infrastructure development in North America, where we desperately need it, especially in the areas of attacking the drought in the West, high-speed rail, and so forth. So that brings us to the subject of national credit. And by that we don't mean, when LaRouche talks about national credit and banking, he doesn't mean sound banking practices. Those are involved, obviously. But national credit and banking means the national control of the issuance of new credit into the economy in such a way, either by the government or as a result of this control by private credit being issued, but issued in such a way that that credit and that currency which is issued stays in the national economy. It does not fly out in the form of payments on foreign debts. It does not fly out in the form of speculations on international securities ventures. It stays, that credit stays in the country and goes into the real economy, is directed into the real economy. That issuance of credit is what he means by national credit and banking, one in which credit is not only generated in sufficient amounts for the real large-scale investments and projects that are required, but it is also controlled in such a way that that credit and that new currency stays in the economy and goes into the real economy of manufacturing, of crucial services, of education, of infrastructure, of science and technology. These things also involve the direction of credit, which is sometimes attacked nowadays and called picking winners and losers, meaning the direction of credit to develop breakthroughs in technology and breakthroughs in productivity in the economy. Alexander Hamilton, for example, and his collaborators understood that the direction of credit was the key to the development of the future United States when the first national bank was formed. That if credit existed in the U.S. economy but was allowed to go wherever private capital wanted to put it, that it would tend to go to the areas of highest return. That would usually, short-term return, that would usually mean it would go into real estate in one form or another. And they understood, because especially since the country appeared to have such unlimited amounts of real estate from the East Coast all the way out to the West, and they understood that that kind of direction of investment into unimproved real estate, meaning real estate not improved by the infrastructure which makes it productive, that would lead to rapid booms and busts. And that was why Hamilton insisted in his report on manufacturers that credit not only needed to be created, but it needed to be directed so as the United States would develop a manufacturing capability, manufacturing industry, and would not remain a rural, agricultural-only country, which the Jeffersonians and others tended to believe in. So those characteristics are the characteristics of a successful national credit system, one which those countries in the BRICS now are moving towards implementing. China's investments are extraordinary of its national credit. It has sacrificed a great deal. It has made economic sacrifices over a long period of time in order to accumulate foreign reserves in very, very large amounts, which are the basis for its generation of national credit outside or in complement to the tax revenue that it collects domestically. And that has enabled China to make immense investments. It has built 6,000 miles of high-speed rail in the last 6 years, for example. That's not just rail. That's rail that travels at 200 plus miles an hour for passengers, 100 plus miles an hour for freight. It's building another 6,000 miles in the next 6 years and intends overall to build as much as 50,000 miles of high-speed rail outside China by the extension of its national credit into other countries, and or in collaboration with other countries. It's essentially this kind of policy which is now being made the policy of 5 countries in the BRICS grouping in the formation of this new development bank. But the accumulation of foreign reserves by exporting, as China has done, is not the only way that this kind of national credit capability can be generated. It's not the way, as I'll go through, that this has been done in the history of the United States. As I mentioned, national credit means that credit and currency stays in this country. It's issued and it stays and is used in this country unless, and in those cases where we wish that it should go abroad in order to invest in developing productivity in other economies, in order to create exports, technology exports for us, in order to increase the productivity of the world economy involving trade. Otherwise, it circulates and is invested and stays in the U.S. economy. That kind of national credit is what Lincoln's famous economist Henry Carey called the benefits of having a non-exportable currency, which is an essential part of a national credit policy. Now, we don't, since 1971, decisively, the United States has had no such currency. Our dollar is not a United States dollar. Our dollar is a Wall Street, London dollar. Wall Street and London control how much of it is printed. They control where it goes and what it's invested in. The United States government has virtually nothing to do with that, and in fact is also saddled with a Federal Reserve Bank which feeds aggressively into the exporting of our currency into speculation all over the world. This, for example, in trade, in foreign trade, the dollar is the international reserve currency for foreign trade. 98% of all of the dollars in foreign trade are the result of hedges and derivatives and speculations on currencies. 2% is the amount of dollars actually necessary for the trade involved. So 98% of the dollars in international trade are private speculations, and the great majority of them are foreign exchange derivatives speculations. And that is only concerning the market for foreign exchange speculation. That the dollars in circulation for trade, actually taking part in international trade, for which it is the reserve currency, are a far, far tinier percent than 2% of the total use of the dollar overseas. In fact, already by 1979, more than 2/3 of all dollars in the world were circulating outside the United States. Now, this was not the way the Bretton Woods system was set up in 1945 under the leading impetus of Roosevelt before he died. The way that was set up is that the United States issued credit, for example, through plans such as the Marshall Plan, that they were very controlled means by which U.S. credit was exported outside the United States in order to create recovery, economic recovery in specific European countries, and it did not result in the buildup of dollar reserves in those countries because of the way it was done. Rather, it resulted in the creation of development banks in those countries, such as Germany's Kreditanstalt für Wiederaufbau. This was the situation intended by the Bretton Woods system. Beginning in the late 1950s, there began to be a flow of dollars into accounts in London offshore locations like the Cayman Islands, the Jersey Islands, and so forth, where dollars were being invested in offshore accounts which had no connection to trade and were not for the purposes of trade at all, but rather were going there because they were being given high rates of interest on those accounts, and those accounts were being used to speculate in securities, including foreign debt, European government's debt, but also securities of all other kinds. This is the so-called euro-dollar market, by which the United States lost all control of its currency over a period of time in which it became essentially the London dollar, or the London Wall Street dollar rather than the U.S. dollar. President Kennedy was the last president who was aware of this and wished to reverse it, and was discussing, and this is, the historians record this, that he was discussing with his advisors reestablishing the currency controls and capital controls on the export of dollars in order to stop it. These controls were nominally still in effect, but they had been completely unenforced, and the Bretton Woods system had been allowed to effectively break down by the later 1960s as a result, when you had these huge volumes of speculative dollars going offshore to get high rates of interest and then going into speculation and out of all credit control of the United States. This, after JFK died, was assassinated, there were no further attempts by any president to do anything about this, and so today we have the absurd situation where 99 and 9/10% of all of the dollars circulating internationally are circulating in these various speculative avenues, and the vast majority of them outside the United States economy. This is not what was intended by being a reserve currency. In fact, under the Bretton Woods system, it was not permitted for a dollar account to exist outside the United States, in any bank outside the United States, unless the holder of the account had proof, documentation, that the purpose of that account was for payments in trade, the export and import trade, and arranging the payments for that trade. It was with the euro-dollar market that this was abandoned and was allowed to go. And this led, in the course of when the Glass-Steagall Act was then repealed, so that then we also lost control of what the private banks in the United States did with their deposits, which were obviously internally generated savings. We lost all control of what they did with those deposits. They were now permitted, after Glass-Steagall was eliminated, they were permitted to throw these deposits, form their own investment banks, buy investment banks, form hedge funds by the hundreds, buy hedge funds, throw those deposits as dollars into any form of speculation anywhere in the world, by which they imagined they would make more money than lending it to businesses and households in the U.S. economy. So then we had lost all control also of the circulation of credit such as it was in the private banking system with the end of Glass-Steagall. It led to what I call the crime of the century, which is the policy of the Federal Reserve in the period since the crash of 2007, 2008, in which the Federal Reserve has created during that period of time $3.5 trillion worth of new U.S. currency. It has sent more than half of that currency into European banks, many of the same banks which had been bailed out, which would have failed in the crash if they had not been bailed out by their countries. It has sent more than 2.2 trillion of the 3.5 trillion into European banks through their U.S. subsidiaries. It has put all of that $3.5 trillion at the disposal of major banks by buying securities from them. This is the so-called famous quantitative easing programs 1, 2, and 3, and infinity. And in that same period, as a result of that, the amount of deposits in these banks in the United States have grown by $2.3 trillion in deposits. And in spite of that, or really because of that, the amount of lending, that is bank lending to households and businesses and farms in the United States from the banking system, has only this month finally returned to the level of 7 years ago, mid-2007, and in Europe is still lower than it was 7 years ago and is still falling. This has completely starved the United States economy, and even worse, the European economies, of credit, so that they have been absolutely stagnant. Mass employment, part-time employment, low-wage employment, persistent and worsening poverty throughout that whole period of time, while $3.5 trillion of new U.S. currency has been created in such a way that it would almost automatically flow through the largest banks and into international speculations, and other of it would remain with the Federal Reserve itself as excess reserves. Just in the last 4 years since the Dodd-Frank Act was passed, the amount of just cash sitting in the accounts of the largest banks has increased by 4% of GDP. That's equivalent to about $550 to $600 billion increase in effectively idle cash on the accounts of the largest banks, in addition to the reserves that they have with the Federal Reserve and the speculation in the derivatives markets, which is where most of this has been invested. So this really has been the financial crime of the century that the Federal Reserve, the Bank of Japan, the Bank of England have carried out with the quantitative easing programs. But when it comes to the United States, it is the demonstration also that what we call our central bank is a leviathan, an immense private bank among private banks. It's a gargantuan private bank among huge private banks, to which there is a lot of government control of one sort or another in what the Federal Reserve does. But nonetheless, the key is that it does not function as a commercial bank in any way. It does not, for example, buy municipal bonds from states, issued by states or municipalities for infrastructure. By policy, it does not do that. It does not lend otherwise for infrastructure development. By policy, it does not do that. It is not even an investment bank. It is merely a reserve for the banks, and not even for the banks, but rather only for the largest of the banks in the United States and Europe. It is not in any sense a national bank or a source of national credit, despite the fact that it may appear that the Federal Reserve is issuing huge amounts of credit into the economy. It's certainly printing huge amounts of money. Nonetheless, it is doing exactly the opposite. So it would be useful to just review how, since we in fact have a very deep tradition of national credit and banking in the history of the United States. It's much older and much deeper than the Glass-Steagall Act, for that matter. The Glass-Steagall Act is a very powerful precedent to restore. National banking and credit is an even deeper and more powerful precedent in our history. It's what accounts for what the United States has been through the 19th century and most of the 20th century, the greatest industrial power that the world has ever seen. Anton Chaikin of EIR, in his fascinating book Treason in America, and also in numberless EIR articles and presentations, has made it clear that the United States history from 1800 to 1950 can be divided into periods when we were pursuing Hamiltonian national banking, that is, national bank credit, tariff protection of new developing industries, and heavy investment into new infrastructure. That those periods were periods of rapid industrial, economic, and living standard growth, and that other periods, for example, the period immediately before and after the War of 1812, and then worst of all, the period from the second presidency of Andrew Jackson up to the Civil War, when we completely abandoned these Hamiltonian principles, they were periods of stagnation and worse, and the latter of them a period in which the country came within a hair's breadth of falling apart, and the whole southern part of the country again becoming a colony, a combined colony of Great Britain and Spain, had the slave interests been able to actually split the country at that time. Also, James Blaine, who came very near to being the Republican presidential candidate in 1876, was the Secretary of State, and for a long time a leader in the Republican Party in the Congress, wrote a history in the early 1890s of the United States from the Louisiana Purchase in 1803 up till the time when he was writing, in which he demonstrated, as Anton has done, demonstrated that when Hamiltonian policies were carried out, including national credit and banking, the United States grew rapidly, and in fact grew to become the envy of the world. When they were not being implemented, it stagnated. So if we start with Hamilton and Hamilton's first national bank, Hamilton made a national bank out of debt. This I'm sure you've heard before. He created a bank for investment, which drove growth in the country in its early years, almost entirely out of existing and unpayable debt. We have been reporting and discussing and backing Argentina, because Argentina 10 years ago, after having completely unpayable and illegitimate debts and defaulting on them, Argentina did a debt restructuring in 2003 through 2005 successfully, in exactly as LaRouche had laid out how you do this in Operation Juarez, the document that he wrote in 1982 for the President of Mexico and the Presidents of Brazil and Argentina at that time. As LaRouche specified in that eight-step process of bank restructuring, of debt restructuring, the country at a certain date, very suddenly, but if possible by agreement with creditors, cancels outstanding bonds representing the debt of that country, issues at the same time replacement debt instruments which have a longer maturity, but at the same time have a higher rate of interest, and hopefully by agreement with the creditors, as was the case in Argentina with the overwhelming majority, 95% of the creditors, by that agreement, the amount of total principal owed on the outstanding debt, which the country has been unable to pay, can also potentially be reduced. But the length of the replacement issues is longer, the interest rate is higher, the interest rate on the restructured Argentine bonds is quite high indeed, and that makes a successful restructuring, one which in Argentina in the last decade has been followed by the highest rates of growth in South America. In fact, rates of growth second only to those of China in the world as a whole. So what Hamilton did in creating the first national bank of the United States was essentially a debt restructuring very much like that. He, as everyone knows, faced a situation where the United States and also the various states themselves had accumulated debts during the Revolutionary War and in the Confederation period, which they could not pay and which they were not paying. And Hamilton assumed all those debts into federal government debt. That much is known. What he, by everybody, what he did was to restructure those debts by inviting those who held them to turn the instruments of those debts into the new Bank of the United States and invests them in the Bank of the United States as its capital. Essentially, he said, if you are holding debt of the state of Virginia or the Continental Congress or the United States, which chances are has not been paid recently, put 75% of your investment in our new national bank in the form of these debt certificates that you have from the United States or Virginia or the Continental Congress, whatever it is, and 25% of your investment in the capital of our new bank in gold and silver specie. And what you will get in return is what we would call today a debenture, a stock investment in this bank, but which has a long-term payout of 20 years, a rate of interest of 6%, 5 to 6%, depending on which of a number of options the creditors chose that Hamilton offered to them. And by taking one of those options, they received a 20-year bond of this bank, one which paid a rate of 5 to 6% on interest, and one which was an annuity. That is, the creditor who got the investment in the bank could not cash it in before 20 years was up. The government, on the other hand, the bank, could choose to cash in the creditor's investment at any time before that, if it wished to, in order to increase the capital of the bank, in order to bring in other shareholders and so forth. But the investor was putting in that debt, and that 25% of gold and silver coin was putting it in for 20 years. Both Hamilton understood and the investors understood, of which the biggest were a number of European banks. They understood that if Hamilton's intention for investment of credit into the U.S. economy was successful, if the economy grew and wealth production increased in the United States, then in fact these securities of the Bank of the United States, which they were getting, would remain at their full par value or very close to that, and they did, and therefore they would be able to borrow against those securities of the Bank of the United States that they were holding. So in fact, the investors understood that they were not really giving up all of the use of their capital for 20 years, and Hamilton understood that as well, and understood how to organize this. Now, it was associated, and the response was overwhelming. $10 million was what he needed to raise for the capital of this new bank. 20% of it was to come from the Treasury, and 80% from the holders of this non-paying debt that was out there. In fact, he was able to get the entire amount subscribed from the holders of the non-paying debt which had already existed, and the bank was able to lend the U.S. Treasury the $2 million which it had to put in as capital, so that in effect it was never necessary for the Treasury to make a capital investment in this bank. It was invested, and it was overinvested because a portion of it, a quarter of it, was in specie, which was over and above the debt which was being restructured by the bank. Now that then put the Treasury in a position to issue currency. Hamilton, being the Treasury Secretary, as is well known, established the first mint of the United States and its subsidiary mints, and they created a currency for the country, and that currency was then able to circulate and stay within the country. It did not go abroad to pay debts, and in fact, the bank had taken a $10 million debt burden off the shoulders of the Treasury, which enabled the Treasury then to issue currency very much in coordination with the amount of debt which had been reorganized by Hamilton through the National Bank. And that currency, combined with the ability of this new national bank to lend, made it possible for the United States to invest in the first ports, a network of roads, the very beginning of the network of canals during the period of the First National Bank, and this was much expanded in the period of the Second National Bank from 1818 through 1836. which operated according to the same principles. Now, there were taxes associated with this, the creation of the bank by Hamilton and the creation of national credit through that bank. And anyone who tells you that, you know, the ideal would be for the government not to tax us and not to borrow any money from us is really proposing that we do like Ireland and Iceland have done in the recent 20 years, where they made themselves fantasy lands for a certain period of time with virtually no taxes and very little government borrowing, and they lived on the fact that they were paying high rates of interest for massive investment from outside, which was coming into those countries. Then, of course, those bubbles blew up, and they paid the price of trying to become fantasy lands with no taxes and no borrowing and simply high rates of interest. Hamilton and Washington understood the necessity of taxes to support the national debt which was being created. Hamilton said, a national debt is a national blessing if the means for extinguishing it exist. The means for extinguishing it in the long term were the growth, the future growth that was going to be created by the investments through this bank, including the government's own investments run through this bank. That is, government revenues being put in the bank to be invested into the economy. That was the long term. In the short term, there also had to be provision for the means of repayment of this debt, and there were excise taxes created to do that. And Washington personally led the first anti-tax resistance campaign on horseback himself in Pennsylvania, in order to make sure that it was a military campaign in order to make sure that the first taxes of the country were actually paid, in addition to the customs revenues, which actually produced more revenue for the customs on imports. So that this bank essentially enabled it enabled the Treasury to print currency in relation to the $10 million of debt which had been restructured in this bank, and it also enabled the bank then and the Treasury to tax back that currency and to borrow back that currency, and then to invest it again, to circulate it again, providing at the same time that the means for repayment of the debt which was being issued were also being provided. There was a sinking fund which was made for the payment of interest on this new debt, which, remember, for 20 years there was nothing but interest to be paid. There was a sinking fund made out of the revenues of the new post office, which Hamilton also was in charge of, and that revenue plus excise revenue and customs revenue made sure that all of the debts arising from this investment in the future productivity of the country were able to be paid. Now, in the period when national banks were abandoned from Andrew Jackson's presidency until the Civil War, the national currency disappeared. We entered a situation where there were 1,000 currencies circulating in the country at the same time. By the time of the Civil War, they were not currencies at all, but banknotes printed by various state banks, so-called. And Lincoln confronted a situation in which the country essentially had no currency and also had no ability to borrow. And Lincoln, along with the Republicans in Congress, created the greenback policy of national credit and banking in order to deal with that. The government, after finding that it could not borrow for the war in 1861 at less than 12% abroad or on Wall Street, and then finding that it couldn't borrow at all the second time it went to the market, and then having the Wall Street banks turn around and cease paying out gold and silver and propose to the government that they would print their own currency. The Wall Street banks would print their own currency and lend it to the government at a high rate of interest in order to fight the war. They were being blackmailed. This was a situation where the United States did not have very much external debt, but it clearly did not have credit either. as a result of the disaster of the years since Jackson and the no banking policy of Andrew Jackson, so-called. So the government then printed greenbacks, $460 million worth of greenbacks in 1861 through 1864. And it then proceeded to borrow. That then put currency into the hands of the soldier, the contractor, the artisan, the craftsman, the farmer, then had currency. Not a lot, but they had currency, and the greenbacks were in small denominations. So they were broadly circulated. The government used them to pay for initial expenses of the war. They then borrowed the greenbacks back by issuing 20-year 6% bonds. If that sounds familiar, it should. They also were bonds which were annuities, that is, they were not callable until 20 years was up, except by the government. The creditor could not call them for 20 years. But they were at 6%, and those were the means by which the government borrowed back the currency that it had put into circulation so that it could continue to pursue the war, but also to make the investments which it was making in the railroads, in the steel industry, in the state colleges, in the iron industry, in the coal, the development of the first development of coal. And again, taxes were associated with this. Lincoln was no sissy when it came to taxation, and neither were the Republicans in Congress. They established the Morrill Tariff. This we all learned about in junior high school or high school in 1861, and then there was a tax levied on businesses across the country, and then there was also an income tax. So if anybody tells you the old saw that we never had an income tax until the Federal Reserve in 1913, it's not true. Lincoln and the Republicans established an income tax on higher incomes, incomes over $800 a year, quite a lot at that time. And though the issuance of the greenback currency essentially enabled the government to borrow back and to tax back that currency and then to invest and spend it again. Eventually, $1.2 billion worth of borrowing was based on the $460 million worth of greenbacks that had been issued because of the rapidity with which they circulated. All of this stayed within the United States. The government bonds, borrowing which was done, those bonds were bought by Americans. They were bought, including in very small denominations, by Americans using the greenback currency. The government was no longer borrowing from London and Paris banks in order to fund its operation and fund the war. It was instead borrowing from the American people, and it was providing them with the credit and currency with which they could loan to the government and with which they could pay each other. And it was providing itself with the means to invest at the same time in the new industries and infrastructure which made the United States economy expand so rapidly and industrialize so rapidly from the Civil War to the end of the 19th century. Despite the fact that there were famously bank panics during that period of time, those resulted from the fact that as soon as the war was over, Andrew Johnson came in and his Treasury Secretary said, let's call back the greenbacks. And he started to contract the circulation of the greenbacks down from $460 to $330 million. Congress fought back. It went back up to $360 million. And that is where it is today. The current limit of greenbacks which can circulate in the United States today is still $360 million. Because of that battle at the end of the war, Lincoln's great economist, Henry Carey, fought this very hard all through the 1870s, said that that the country should print more and more and more greenbacks, well over $1 billion in new greenbacks, because it not only was developing rapidly, but it also had all the southern states which had been brought back into the Union gradually. And those states had remained undeveloped from an industrial infrastructure standpoint. for the whole period of the first half of the 19th century. They needed to be developed as the rest of the country was developing, and Carey insisted that a great deal more national currency was necessary for that. In the 1870s, he proposed that the government issue $1 billion in greenbacks and make those greenbacks convertible at will by the person who had them into bonds paying 4% of the federal government, so that you could, if you needed your greenbacks, you used them as currency. If you didn't need them and you wanted to save them, you got a 4% bond from the government in exchange. You could then go back and get your greenbacks back again. That's what Carey proposed. Just the relatively small amount, $4 per person, is what the $460 million of currency was. $4 per American. That small amount of currency, because of the way it was used, and that it was national, as Carey said, a non-exportable currency, and was used for directed investment. It was the engine for the development of the United States in the second half of the 19th century. And we come to Roosevelt, who clearly wanted to form a third national bank. Roosevelt, after reorganizing the banks in the bank holiday and passing and getting Glass-Steagall in place, he then sent to Congress legislation which, and he sent it to Glass and to Steagall again, legislation which would create a lending bank in each of the 12 districts of the Federal Reserve. And that lending bank would use certain surpluses which the Federal Reserve had, for example, the surplus on FDIC deposit insurance payments, since those were now being collected under the FDIC law, and it would use the revenues of the United States in order to generate $550 million in each of those 12 banks, $6 billion plus in investment capital total, and invest them in the industries of the country. That was Roosevelt's proposal. It was blocked by Glass, as I indicated last week, the miracle of the Glass-Steagall Act is that Carter Glass ever came within 1,000 miles of it. And when it came to Roosevelt's proposal for, in effect, creating another national bank within the Federal Reserve, Glass blocked it. And it became a fight all during the 30s and the 40s to try to make the Federal Reserve at least discount lending into industry by the private banks if it wouldn't do any lending itself. Something that it never did, so that Roosevelt then went to the Reconstruction Finance Corporation as a means instead. And again, this was never financed on the budget. This was never a matter of collecting tax revenues and just spending them for infrastructure. The RFC was financed off the budget by credit issuances which were raised by the Treasury for the RFC and were then invested in directed credit into the economy. And and produced the most extraordinary productivity. For example, there is a measure of economic productivity known as total factor productivity. What this is an attempt to take the growth of GDP and take away from it what comes simply from more labor being employed for more time, and take away from it what simply comes from more capital being invested in the same way, and take away from it also the changes in the education of the labor force in order to try to determine how much of the growth of the economy is accounted for by technological progress. And not surprisingly at all, the decades of the last 130 years in which total factor productivity has grown most rapidly were the 1930s and the 1940s. In the 1930s, it grew even more rapidly than during the war mobilization of the 1940s. Such were the impact of the investments in electricity, for example, and the first electrification of the farms, which had never been attempted before in the United States. Such was the impacts of the building up of the large industrial capacities which were used for the war, the building up of the immense industrial plants which were used for the development of nuclear energy and nuclear weapons, and all of the investments in tunnel building, in rail building, in the construction of dams, which changed and modernized the methods which were used for all of these forms of infrastructure construction during the 30s, produced rates of growth of productivity which were even greater than those during the mobilization immediately during and immediately after World War II. So this was possible because of what the RFC was able to do. That's the Roosevelt's fallback for national credit, and its impact on banking was that when he was blocked from what he really wanted to do, which was to start to convert the Federal Reserve into a national bank and to make it function as a commercial bank or as a series of 12 commercial banks, using the tax revenues of the government as a pass-through and also using them as a multiplier for additional borrowing and additional credit to put it into the manufacturing economies of the country. So clearly we have different, Congress today has different approaches which it could take to creating national credit and banking again. I should have mentioned in discussing Lincoln's greenback policy that there was a second step to it after the issuance of the greenbacks and essentially the borrowing back and taxing back of the greenbacks and the investments, the deep investments which were made, is that they also, the Congress then also required that all the state banks which were still out there issuing their own currencies, their own banknotes, that all the state banks, in order to keep their charters, had to use their banknotes to buy the bonds, the 6% 20-year bonds, which were being issued by the government. And they had to keep those bonds in their capital permanently, and in fact they had to turn over that part of their capital to the Treasury itself. And this is the Office of Controller of the Currency was created 150 years ago this year in order to hold that government bond capital for the banks. They had to do this in order to keep their charters, and having done this, they then were able to circulate the greenback currency as well as their own banknotes out into the economy, but they were at the same time providing part of the credit with which the Lincoln administration was both fighting the Civil War and at the same time making these extraordinary investments in the future productivity of the country. That's exactly what Congress has to do now with the assistance of the Glass-Steagall Act in order to make sure that we have at least lending banks whose charters require them to lend and require them to use credit and currency which comes to them for the process of lending into the economy. Provided we have that, Congress could, for example, right now create a national bank, and there is $12 trillion of publicly held U.S. government debt out there in the world. Invite the holders of that debt to invest it into the capitalization of a National Bank of the United States for infrastructure, with the aim of achieving a $1 trillion investment in United States National Bank for infrastructure, $1 trillion of existing, already held U.S. national debt being converted into longer range, higher interest, at this point it could hardly be lower interest, into longer range, significantly higher interest debt of a new national bank for infrastructure guaranteed by the Treasury, and by attracting $1 trillion worth of that debt into such a bank, it would remove $1 trillion of the debt burden from the Treasury, which could then print exactly as Hamilton's Mint did and as as Lincoln with the greenbacks did, it could then print Treasury notes, not Federal Reserve notes, but Treasury notes, as an issue of currency in the same range of $1 trillion, and use that as directed credit also for the most important investments in infrastructure, for contractor payments on those investments in infrastructure, for also the purpose of joining in the new development bank, the Asian Infrastructure Investment Bank, and the other banks which have been created by the BRICS powers. So that gives an idea of national banking and credit, and let me end there and see if there are any questions.
Okay, thank you very much, Paul Gallagher. For those of you just joining us, this was a discussion with Executive Intelligence Review's Paul Gallagher on the second of Mr. LaRouche's four laws to save the nation. Last week we had Glass-Steagall. This week was national credit and banking. If you do have questions, you can send them to LaRouche's 4 laws, and that's numeral 4, not F-O-U-R, but 4 laws. LaRouche's 4 laws at gmail.com. We'll try to get back to you with a reply as soon as we can. But in closing, I can ask if Paul, if you have any closing remarks, but I can just say that we have 1 more week of Congress left. We're going to have several weeks of recess where the Congress is going to be back in their districts. We are mobilizing all of LaRouche PAC's greater network of organizers and activists to put the heat on the Congress, to, of course, immediately move for the impeachment of President Obama, and move with Mr. LaRouche's 4 laws as we have been discussing on this series. So I would just ask if you had any closing remarks, and if you had any orientation for our organizers and our activists for how to get this accomplished with 1 week of Congress and 4 weeks of Congress in the districts remaining.
Well, you know, Lyndon LaRouche has been pretty clear and insistent and repeated and emphatic that you open the door for this with the impeachment of Obama and the restoration of Glass-Steagall. That both politically and also in terms of how such a thing works economically, but even more so politically, that's what cracks it open. The situation with the BRICS Bank and the AIIB and so forth, it gives us a new situation in that it's absolutely clear what the United States has to join into if we're ever going to have growth in this economy, if we're going to avoid the next financial crash which is running at us, and avoid world war. It becomes much clearer with those new banks and those actions by Argentina and the BRICS what we have to join and what kind of policy we have to reorient to internationally. But as I say, Lyndon LaRouche has been absolutely clear. It starts with Obama and it starts with restoring Glass-Steagall, and that creates both the economic condition, but more importantly, the political shock, which makes it conceivable that Congress would move off of the platitudes is not even the word, the ridiculous talking points that we constantly hear from them on all subjects which have anything to do with money, spending money, investing, or anything of that sort. That's really where it has to start.
Yes, I'd have to agree. So thank you very much, Paul Gallagher from Executive Intelligence Review, for joining us today. You can join us next week on this channel for Part 3, and then following week Part 4 of LaRouche's 4 Laws to Save the Nation. So thank you. Thanks for tuning in. And
okay, thanks, Spencer.